I'm Elizabeth Warren, the chair of the Congressional Oversight Panel. I'm here to introduce our 7th monthly report, Stress Testing and Shoring Up Bank Capital. If you're like many Americans, you've been working out your own stress tests lately. You've probably asked some tough questions. How well could you manage if the economy took a turn for the worse? If you lost your job, if your credit card interest rate skyrocketed, if your home plummeted in value, could you still make ends meet? Similarly, when the government recently ran stress tests on the country's 19 largest banks, it looked into the same types of questions. What would happen to a bank if more homeowners stopped paying their mortgages? What if the unemployment rate rose by 2% and more people couldn't pay off their loans? What if credit card revenues dried up as people used their cards less and saved more? All of those questions help to answer one central point. Could banks weather a worsening storm? In a stress test of your personal finances, the results would depend on two big factors. First, how bad do you expect your finances could be? Are you worried about missing a few hours of overtime, or could you be laid off indefinitely? Second, how much money do you have saved? If you've got enough cash to cover a few months of expenses, then you're much more likely to weather a storm than if you have only debts. In the bank stress tests, regulators confronted the same kinds of questions. First, how far could the economy fall? For example, how many more foreclosures and mortgage defaults are coming? Will unemployment rise no higher than 10%, the worst case scenario built into the stress test, or could it hit 11 or 12%? Second, how well protected is each bank? A bank that has plenty of capital, cash and cash equivalents from stock sales or reserves, or even from TARP, is in a much stronger position to survive. The panel begins with the tests themselves. We engaged two outside experts, Berkeley professor Eric Talley and Johan Walden. They dived into the complex model used to evaluate future risks. They concluded that the Federal Reserve and the Treasury had chosen conservative models, increasing the reliability of the analysis. But there remain serious concerns. The tests analyzed two sets of circumstances. The first were standard economic predictions from last February when the tests were begun. Second were worst-case predictions if things really headed south. The problem is that by May, the conditions were already worse than the harshest conditions built into the stress test last February. If these troubling trends continue, the test should be repeated. In fact, repeat testing is a good idea for so long as the banks continue to hold large amounts of toxic assets. And in between the formal stress tests, banks should be required to run internal tests and share the results with their regulators. In a time of crisis, these tests can give us a sense of the strength of the banking system and help us sort out stronger banks from their weaker counterparts. The tests also projected losses only until December 2010. Now, making long-term forecasts is harder and it's more error-prone. But to ignore well-known problems is very risky. For example, many existing commercial real estate mortgages and other loans on the bank's books, including their toxic assets, may cause substantial losses after December 2010. But for the most part, the stress tests do not take those potential later losses into account. Another concern is about the stress tests that many of the key details of the model and its implementation have been withheld by the Fed. Without those details, outside researchers cannot repeat the tests using different assumptions. Repeating the tests under different conditions would help us understand whether the tests are robust. That is, whether they will stand up if the numbers are just a little bit off or if something else goes wrong. Similarly, if we had more details, outside economists could run the projections based on 3 or 4 years of losses. So we're returning to a central oversight theme: transparency, clarity, and accountability. We applaud Treasury for releasing more data than ever before in history, But we believe that Treasury and the Fed should release even more details about the methodology and the results of the stress test. Finally, we cannot ignore the fact that the bank's numbers were self-reported, and the supervisors who administered the stress test were part of the same system that monitored these same banks in the run-up to this crisis. The credibility of the stress test relies on the credibility of the bank reporting process. Also, the regulatory system that allowed this crisis to develop has not changed. You can read our full report and offer your own thoughts at cop.senate.gov. That's cop.senate.gov. The markets are calmer than in the past, for which we are all grateful. But no one should forget that this calm was purchased with hundreds of billions of taxpayer dollars and trillions in taxpayer guarantees. The households that pay those taxes are still struggling to survive, with no bailouts headed their way. We remain in an exceptional crisis, and oversight has never been more important than it is today. Please stay involved.